importance, the difference between, I suppose, paying too much tax and only what you need to is based on making an investment in time with a professional who understands your particular circumstances. So what I'm going through today is general in nature. Don't act upon it because it is general, to give you an outline on the tax treatments, etc. If in a normal tax return you went to 10 different accountants, you would think that the bottom line is the same. I can tell you it's not. Because it depends on the attitude that the accountant has with their staff, getting the best outcome for a client. So if someone's not asking questions, if you never get asked questions either in business or personally to complete a return, I can guarantee you that you shouldn't be coming up with all of the creativity. So if you're not being asked questions, then it's going to be a sub-performance tax return for you. Just like now, hopefully today, you will learn some things and you'll probably realise that maybe you haven't got the ultimate situation that you could have with Zoocoins or crypto generally. So let me just two figures. So how is it treated for tax purposes? So crypto is classified as a capital gains tax asset. So unlike people who trade in shares or investments, it's in the same asset class as shares and real estate. And as John's mentioned, if you hold that asset for 12 months or more, you get a discount of 50% for individuals and trusts. So it's not taxed on a income basis. So what are the benefits of a CGT asset? It is that 50% discount. So people who trade shares all the time and volume and they're in that business, basically their margin is taxed at their marginal rate if they're an individual. Here, it is of benefit to those who hold crypto because you do actually get that 50% exemption. So only individuals and trusts, a company doesn't get it. Now, you might be thinking, hang on, I thought companies' tax rate had dropped down to 25%. Yes, for trading companies. So if you've got a business, you're taxed at 25% for that business. When it's passive income and investments are not considered a business, that's why that rate is 30%. So it's not a mistake, because obviously all presenters today have mentioned the tax rates. That's why. So if you do make money in a trust and you distribute it to a bucket company, it will pay 30%. So there's our current lay of the land for this financial year. As you can see, first 18,000 is nil, 18.2 to 45 is 19, 45 to 120, 120 to 180, and over the 180. So on these rates, 32.5, 37 and 45, we've got to add our Medicare levy of 2% on top. The reason they're shown like that is one or either can change independently, so it's important that people know that. So if you have all of your Zoocoins held in an individual name, I would generally say that is not an optimum position. If one out of a couple holds it all in their name, that is not the best situation. If you haven't got your super fund involved, it can't be a great situation. So what you've got to do is you've got to say, well, how many do I hold? What is my strategy? What am I going to be selling? When am I going to be selling? At what points will I create an amount? And how am I best to spread that amongst my group? Because no one wants to be paying 47.5 when you don't need to. As you saw with the figures that John mentioned, yes, you can take the top off it with a super contribution, but where the price is expected to go over the long term, you know, you don't want to be in a situation where you're carrying too much in your own name. So it is a balance, and it's not having it in just one of those options.
My wife suggested that I sell them to the super fund as the individual.
Unfortunately, I will cover it, and I'll cover that off there, but it's a no-go.
Can't do it?
No. not from yourselves to your own super fund. Nor can you sell real estate that you own personally to your super fund. It's considered
Super fund-
in-house.
Super fund can't buy it off you either.
Super fund can buy it off someone in this room because they're not related to you, they're not a member of the super fund, but you can't sell it. You can sell it to your own trust, that's not a problem. It's just super has its own special rules, because ideally the government's trying to make sure the more people they have self-funded retirees, the less they have to pay pensions to.
Yeah.
So there are some restrictions on what you can do.
So you can't sell the individual to the trust and then the trust sells it to the super.
The trust is still related to the group.
Yeah.
So we've got investment or bucket company 30%, discretionary trust nil. Don't get too excited. Trusts don't get taxed. I remember a young uni student coming up to me and saying, oh look, all of these people who use trusts are tax avoiders. No, they're taxed at the beneficiary rate. So that could be an individual, it could be a company, it could be a distribution to another trust that's got carried forward losses. So although it pays nothing, what it does make, so if you made $1 million in a trust, you have to distribute that. You can't keep it in the entity like you could. A company makes profit, it keeps it in, it can pay a dividend later on. So you have to distribute that out. So if you make a gain and you've held it for 12 months, you do get that 50% exemption, and then you're able to make those distributions at the end of the year. And it's the trustees who come up with who gets that money. Then you can see with super funds, we've got accumulation 15, capital gains 10, pension in both situations are nil. So happy days if you're Rose. So are there any benefits available? So yeah, the 12 month. So with super funds, they don't get the 50% that individuals and trusts do. So they have a 15% rate. They get a 33% discount, which means the 15 comes down to 10. Now, our non-residents who earn money here, 10 is the lowest that you can be taxed in an Australian environment. And that's why, as John said, the two super examples come first, your bonds, and then other machinations and options that you've got available. So yeah, there's the 1/3 discount. The disadvantage. So the younger you are, the longer you've got to wait to get hold of that money. And that's why, even though super's great, I also would say you have not got an optimum situation if it's all in super. Yes, you can invest in that super, but you can't go buy that car that you want unless it's an antique car, but you can't drive it in a super fund. You can't use any of the assets that you might buy in those special asset classes. So if you've got it all in super, that's also wrong. If it's all in your own name, also wrong. What's that?
Unless you're over 60.
Because you can actually pull that out without restrictions, and that's most of the people in this room aren't in that category. So your age, what you want to do with the funds will determine where you should hold it. Again, if you're wanting to buy a commercial property, that can be done in a super fund for sure, and you get that ongoing benefit of the 10% for capital gains on that building. So if you've got your own business, then Zoo Coins can help supercharge your options in the investment side, which is always best done with diversity. John covered this, and that is if you've got Zoo Coins in your super fund, then it could go to 5 million and it doesn't affect that cap, because that cap is all about limiting how much you can transfer into the fund, not the value that it actually gets to. So that's that one. So the difference in taxes, this has been covered by John, and that is in that matrix we did where the income is taxed at 15. So even if you make your 5 million, you pay your capital gains, the ongoing income that you earn in that super fund does get taxed. It's not a double tax, it's just new earnings that you have within that super fund. So pension phase, we've talked about it, is obviously a lucky thing. But if you're 5 years out, then your window of waiting isn't much. The good thing about the younger people making money from Zoo Coin in super is they may have to wait longer than someone who's older, but they will have the compounding effect of a longer period in super. Now, I remember my dad giving me a Noel Whittaker book when I was 19, and if you put $20,000 in super at 20 and didn't touch it, the balance is over $1 million, which still blows me away to this day that it's that much based on the average return. So that compounding effect is certainly very important. Is it possible to have accumulation and pension at the same time? Yes. Appointment with John. There's something called transition to retirement and options there where you can still be working. You could be reducing your hours, looking to retire, but you're wanting to maximise your super. There are ways of doing that smartly and recycling basically your own funds. So I've heard that crypto wallets can only be held in individuals' names. How then can it be connected with entities? It's a very important one because if the ATO does an audit, how would you today, if you've bought in your own name, doesn't matter how many, how would you prove that that transaction, that you had some in your own name, but you wanted some in your super fund, you wanted some in your trust, some in your company, whatever it may be? Well, if you've done nothing, then you need to plan to have the right paperwork. So it's actually...
Wallets? Can you set up different wallets? You have to like five.
My understanding is that wallets can't be set up in anything other than an individual's name.
Yeah, so
Currently.
He's saying that, for example, because if you've got an Apple phone, you can have multiple wallets with different wallet addresses. If you've got a Samsung, it'll duplicate into itself. He's saying is correct. You could actually go, well, I know that it has a trustee. I know what you're getting to about that.
Yeah. If you can open multiple wallets, that's the way to do it. But for those that can't, and not all platforms will allow you to do anything other than individuals. So my point here is you have an agency agreement. And the agency agreement signed and executed means that on this particular day, I bought this many Zoo coins for this price on behalf of that entity. Signed, proof that it wasn't you, that actually, the proper way is have a full audit trail. So if you wanted to set up a trust because you thought this is a great way to get income to all the right people, then you'd set that up. Then you'd have this agency agreement that says, I'm actually transacting on behalf of this trust, not me. Because if you just are lazy and you leave it in your own name, an auditor comes along and says, well, I've got no real proof here that it was anything other than individual, so we'll take the 47%, thank you very much.
If it came through your book system as a company, wouldn't that be like the accountant sees it and it's part of your assets, it's in an asset column?
Taking money out of your own business or company to buy something is dangerous because they could say, well, it's that entity. So the audit trail is just saying from your company to Zoo coins. If you wanted it in a trust, you haven't solved anything by making that payment directly from the company. So what I'm saying is if you can't get a separate wallet and you have got an entity, then it's very important that you do it the right way. So an agency agreement, you would pull the money out of your company, potentially under a Div 7A loan facility agreement, which is a tax thing I won't go into, but you would be investing on behalf of that trust and you've made sure that it comes out of that bank account. But the whole thing is just prove and make sure that you've got the right paperwork. I will be covering the importance of having the right deeds.
If you have it in a super fund, you should have an agency agreement for your super fund.
If the money's in your super fund, you don't need to prove that one. Yeah. This is more if you actually drew money out of your business or you got money from someone and you put it down in your own name from your own bank account, you're trying to prove it wasn't you. So don't try and dress it up later. Have the right paperwork so that when it does go that way, the ultimate is you loan it to your trust, the trust gets the money, and the trust does it. So this is just to protect people who might be holding all of their Zoo coins in their own name now. You will need to address that situation because it is definitely not the best way to go.
We need to address that before they go to the exchange.
Before it lists.
Yeah, before it lists.
At the moment, the nominal value is 50 cents. If you wait until it's listed, you're at the fluctuation, minimum 100, because the software doesn't allow a trade underneath that. So can I sell crypto from my own name to a partner? Yes, you can. So before, it'll be, if I bought it 50 cents and I wanted to sell it 50 cents, there's no capital gain. But you've got them out of your name to another person. If you wait, then selling to your partner or gifting, they're all caught. It's all a trigger. Even if someone gives you $1, the ATO doesn't care about the $1. They go, it's listed, it's at 120. You sold this many at 120, less this many at your 50 cents. You'll get hit with capital gains. So the before and after is very important. So one of the reasons we're holding this event is to get to as many people. We've got something like 90 people online, is to tell them there is certainly some forecasted planning to do, whether it's super related or investment, whether it's tax structures. If you don't get it, it's too late when you're sitting on certain values, because all you'll be doing is just waiting 10 years to sell off a bit each year to minimise what you're paying in tax versus the flexibility of being able to move it around. I think that's just a repeat. Can my retail super fund hold crypto? No. There are certain classes. So if you've got antiques, coin collections, cars, stuff that's not in the normal investment type, you cannot hold them in a retail fund. Self-managed super funds came about to be able to hold property and things that retail funds have. So don't think you can transfer money from your retail fund cash account to ZooCoins to buy it in your retail fund. No. If I already have an SMNF, can I get some crypto? You can, but a super fund is a trust underneath. Dressed up as a super fund, but it's a trust. If your trustee doesn't allow for crypto, you'll be breaching your trust. Now, I would hazard a guess that no one in this room's ever read their trust deed unless they needed to. Now, this applies not just to super funds, but to trusts. Now, there's been Bamford cases. If your trust deed is more than 5 years old, you need a new one. If you hold crypto in a trust now or a super fund and you haven't, if your accountant hasn't asked you or your solicitor hasn't said, let's look at your trust deed because of this, then they've not been doing the right thing or they don't know this space. It doesn't matter that it's crypto. If your trust deed is old, if it says you can't do certain things that have become a modern investment, you're breaching that trust deed. You've got rights that you have to uphold, whether you're a company director, a trustee of a trust, or a trustee of a super fund. And I should mention, if you've got a self-managed super fund and you or your partner are the individual trustees, please consider not being individual trustees of a super fund. You should have a company that does nothing else other than be the trustee. Example, if you get hit with a fine for running it badly, you both get a penalty. If it's a company, there's one penalty. So it's very complex and it's very easy to make mistakes. And you can't say, I didn't know. That is not a defence. So another tip, if you've got a self-managed super fund, it needs a trustee to give you protection. Okay. Is there any difference if I gift? No, we've covered that. You're going to be hit with it. It's the same if I wanted to gift property. The Office of State Revenue for stamp duty is going to go, what's the value? I don't care that you've only paid $10. That's between you losing that money, but we're not going to lose out on that, nor the capital gains for the tax office. So what are the benefits of ZooCoins in a discretionary trust? Asset protection. So if there's anyone in the room that's a company director, plays golf, well, does anything dangerous basically, we all know that we're living in a litigious society. Whenever we set up structures for people, we set them up with the worst case scenario and hope for obviously the best outcome. So structuring is very important. There is a case, someone was playing golf, hit someone, Long story short, they weren't covered with their home and contents, the golf course said nothing to do with us, and basically the person went bankrupt. So everyone says, oh, I've got insurance for this, insurance for that, but there are people out there whose job it is to get the insurance companies off any claim that you make. So if everything you have is protected just by, it's better to have insurance than not have it, but if you think you're fully protected, wrong. So things can happen. So when it's in a trust, it's away from you to a certain extent for the purposes of bankruptcy, liquidations, family law, but that's another day. Income stream. So this isn't all that you can give it to, but you've got your own parents if they're still around. You've got your children, your grandchildren, your nephews, your nieces. So rather than use after-tax dollars to say, here, go have a holiday, if you've got a discretionary trust and you make 10 million in it, that discretionary trust allows you to say, all adults, so if you've got adult children, they can, through those tax brackets, earn 18,200 tax-free. You can take them up through the adult brackets. So if they're studying or they want to pay their HECS, you can pay them through a trust. If ZooCoins is in your own name, you pay the tax and then after tax you give it to people. So the ability to distribute the wealth from ZooCoins is made easy with this income streaming. After it's, because as I said, each year you've got to distribute 100%, you've then got a bucket company. And a bucket company should be set up at the same time as a trust. If it's not, the ATO can come along under the tax laws and say, the only reason you set that company up a year after this trust is you wanted to cap your tax. So when we set up for businesses or people that they know they're going to have a group going over limits, we set that up at the same time. And the obvious one is legal reduction of tax. That is giving it to the people who can use it. Now, gone are the days where you could on paper give it to people. You have to pay that. Otherwise you build up an unpaid present entitlement. And down the bottom, for those geniuses that think of it, I'll just distribute to the company. Remember that the capital gains discount does not go down to the company. So if you do it to an individual or another trust, 50% discount. If you distribute it to a company, you lose that discount and you pay the whole amount that you distribute at 30. But 30 is better than 47, and 30 is the same as some of the highest super scenarios that you can get. So the question is, overall, where would you go? It's general. Every person in this room would have a different scenario. Someone says, well, actually, I've got a disabled child. I would love to put a chunk of money into a special disability trust. Awesome, we can do that. Someone might already have a dormant company. Great, we can use that as a bucket company. So all I'm saying is, if you've got all of your crypto in your own name, please look at it. If you've got it all in super, please look at it unless you're over. There is a combination there that is the ultimate. And it depends what you want to do with it. So if your next investment is such and such, then, I've got people with bucket companies that buy and sell stuff where they don't care about the discount. But if you're wanting to buy and hold, then a trust is good from that point of view. And super, well, if you have spoken with ACCA and he's told you where it's heading, and he said leave X amount for the end, then super is the one to have that in. Your long-term hold in a super is a premier way of going about it. I was trying to cram in as much as I can. I don't normally talk that fast in a meeting with clients, but just trying to get across as much value to the members.
So I know it's general, but if you have, it's nearly like depending on the individual. Super, get some individual and trust. You could have it across a few. You could buy them in a few different entities.
For sure.
As you go.
For sure.
Yeah.
As I said, individuals, both couples. If it's not in both couples, then the person holding it, so let's say the husband holds it, they'll pay more tax than if you'd at least split it. But I'm talking about looking into the future and saying, okay, it's all in our personal names. We want to get it into this various different entities because we can now see that we're just setup, even if you spread it over 10 years, if each year you're pumping out top rate, you're still paying 47.
So you're saying it's better if you buy it in the company, in the super, that you shouldn't be the trustee.
Not the individual.
Not the individual. So,
Because if you and Megan are the individual trustees of your super fund and there's a fine, you both get hit with the same fine. If it's a company and it's a 10 grand fine, it's only once versus 20.
yeah,
And it gives you protection, because if you're out playing golf, and I know you like golf, and something happens, or you forget to pay your compulsory third party and your car, like the ads, goes down the road and does whatever, or you drink driving, well, you get no insurance cover if you drink driving. So there's some quick things that can happen where you thought you were safe, but you're not. So I'm a man of straw.
so you're,
Groceries is the only asset I have on a weekly basis. And I can tell you with 3 boys under 13, that asset doesn't last very long.
So you're saying with the super, you need to check
The trustee allows for you to have crypto in the first instance. If you don't, what we do is we replace constitutions for companies, we replace trust deeds for discretionary trusts, and we replace super. And we have the conversation with the client to say, do you want a leading member version of this? Because if you're a sole director in a trading company and you pass away after you've bought crypto, you could wait 3 to 6 months. During COVID, it was even worse, before anyone can do anything to control your business. Now, I don't know too many businesses that could last more than 30 days without someone at the helm being able to pay employees, do whatever. So we give a successor director solution to anyone that's a single director.
Yeah.
So it's all about succession, asset protection, paying as little tax as possible.
So it's foolish to think that you can. The rules say you can buy crypto in your super.
You can, but just not from yourself.
Yeah. So no, yeah, but what I'm saying is you still need to check the trustee.
Yeah. You could be going, great, it's in my super fund, happy days. But if your trustee doesn't allow it, you've actually got an illegal investment. Because in super, the government wants you to provide for your future. That's why they say we want an investment strategy. And a lot of people don't know about investment strategies, or they haven't got a strategy that's up to date to include crypto in the percentages of investments that they hold. So there are people that will just blindly not know what they have to do. And that's where the fines from the ATO will come in.
One quick question, maybe more of a general question, of course, we can pick up on everyone's circumstances, but what's your normal situation with the wonderful friends at ATO around payments of CGT? So if someone builds up a nice little nest egg, what do you normally see in regards to that payment of that CGT?
So it's very important to keep track. We actually have crypto tax calculators. So we've got software that's got over 600 wallets and platforms. So if you're out and you've been drinking and you bought some and you've forgotten you even had them, this software allows us to see your investments across all wallets and platforms. We, when it comes to tax time, choose the best method for valuing. So like shares, you want to know if you've got multiple parcels, what day you bought them, what value they were, and when you go to sell, you're choosing the most effective. If you've got one that's a month out, but you really want to make a sale, use a parcel that's only 2 months old, because you weren't going to get the 50% discount. But if you sold the oldest one, that's 1 month from getting to 12, you've just thrown away a 50% exemption that you could have got.
Right, so just quickly, so that then will work out the cost base, so you can say, all right, if I bought them at different prices, this...
Last in, first out,
automatically-
first in, last
Yep.
out. So there's 5 different valuation methods that we can choose. So if you're just doing your own tax and you're going on the ATO side, you won't necessarily be told about all of those.
Over to you, Gav.
Thank you, Rob.